This is Michelle Soriano. I recorded this webinar back in 2010, and the content is still relevant today, although some of the information is older. But let's join in.
Through this, when I'm creating a webinar, I'm always trying to think of, what would be the questions from your perspective. So I've got listed on the screen. If you cannot see the PowerPoint slide, please let me know. But a summary of what we're going to cover today, the glide path. You have to know what a glide path is regarding target date funds. It's kind of a basic premise on target date funds. Bring over that. And you might hear some debate in the marketplace on the difference between a target date fund that goes to your target date versus through your target date. So we're going to talk about that. What does that mean? And fees. Fees are really important. So we're going to talk about how do you calculate fees on a target date fund. And then the most important question is, how do they help you reach your goals? How are they going to help you retire successfully, which is kind of always what this is about. So let's go. I wanted to step back for just a minute and just talk about target date funds themselves. What is a target date fund? There are some folks, I don't think anybody on the call I've worked with for a long period of time, but anybody that I've worked with for more than 5 years, I used to design model portfolios. So you would have your core investment lineup, whatever that was, 12 to 15 funds, and you would fill out a risk tolerance worksheet, and we would design a model portfolio specific for you, having your large caps, mid caps, small caps, your internationals, and your bonds and cash as appropriate for your risk tolerance. So that's represented by the pie chart on the left. Everybody's used to seeing a pie chart for model portfolios and how much you should put in each investment. Now, a target date fund is so similar, but instead of it being static, meaning that it's, once somebody would give you an asset allocation, it wouldn't change per se until you visited with them again, and they would give you a new revised allocation. The model portfolio, the target date funds actually change over time, whether you like it or not. Now, that's represented on the right-hand side. You can see, well, this is really small. We're going to look at some larger charts further down the screen. But basically, the horizontal axis is trying to show the years as they clip along. So there's 35 years before your target date. Target date is always, we assume, age 65, whatever your retirement date is. And then the years after you retire. And then along the vertical axis is the percentage holdings in this example, stocks. And stocks decrease over time as you age, and your bonds increase over time. And the beauty of target date funds, very honestly, is the automatic transition into a more conservative portfolio over time. Because what happened in 2008, and we're all still feeling that dramatic drop in the stock market, is that you don't want to be age 65 and have 90% in the stock market. And honestly, as an investment advisor, I don't care how you decrease your bonds, whether you do it 1% decrease over a 20-year period or a 5% decrease over the last 5 years, but you have to have a plan to decrease your stock exposure over time so that at the age of 65, you have more in bonds or you have a more conservative portfolio than you did when you were 25 years of age. I'm going to ask any questions so far on this.
Not yet.
Okay. All right, we're going to keep going on. Glide path. This is the word, the coin phrase that everybody has to know. So glide path, every mutual fund family has a different glide path, and it's how they decide to decrease your stocks and increase your bonds. And of course, sometimes they introduce a cash element. So it's the definition is that it's a formula that defines the asset allocation mix over the years as you progress to your age of retirement and then after retirement. So that's the glide path. So we're going to see different variations of a glide path, but this is the basic premise. And I want to reference the Department of Labor and the United States Securities and Exchange Commission actually issued an investor bulletin last May, and this is where I'm pulling these graphs from. So I'll go ahead and I'm just going to write a note to myself. I'll go ahead and include that investor bulletin when I send out a recording of this presentation so everybody can read through that. Because some of the items listed in the bulletin you don't have to worry about because it's something I do with your committees and something we take care of regarding the selection and analysis. So this is a sample glide path from Wells Fargo. The red line represents the Wells Fargo equity exposure in each of the different funds by the year. So below you see the years. The 2050 fund, of course, is someone who's going to retire, and God bless them, 40 years from now. And 2010 fund being someone who retired this year. And the vertical axis is showing how much in the 2010 fund was in equities or stocks. That's a very critical element on how much volatility you'll experience is how much is in the stock market. So that's the red line is Wells Fargo. Wells Fargo is one of the more conservative glide paths out there. The dark line is the industry average, and the funds that everybody on the call are in. Everybody on the call is either in the Fidelity Freedom Funds or in the Vanguard Target Date Funds, and your asset allocation is going to be much closer to the industry average when we look at this. These green lines at the top and the bottom are simply the maximums and minimum equity exposures in other target date funds. So, for example, we know that the AllianceBernstein, they've gotten a lot of criticism. The AllianceBernstein fund tends to have a higher equity allocation than most target date funds out there. So that would probably be this top green line. Let's show you then the Vanguard glide path. So this red line, again, represents the Vanguard equity exposure. And you'll see underneath then for each of those years. So let's take an example. Let's say you're in the 2040 fund. If we look at the red line, you probably have approximately about 90% exposure in equities, and that's also the numbers are provided here. And you'll see those folks that retire this year have about 51% in equities. And now that equities is divided amongst domestic and international equities, but it is equities, so the tremendous amount of volatility there. The industry average for the 2010 fund is about 46%, so it's about the industry average. All right, let's look at the Fidelity Freedom Fund. Very similar again, slightly different. I'll just flip back one more time so you can see the red line is the Vanguard, the dark line is the industry average. Let's go to the Fidelity Fund. Very similar, just a little more conservative in the beginning. It gets slightly more aggressive. This is, again, after target date, because you can see we are in the year 2010. It matches the industry average. They do stay a little bit more aggressive after your target date or your retirement age, and then it actually gets very conservative, then about 10 years after your retirement date. So glide paths, very honestly, with every fund family that's out there, each glide path is different from each other. So it's not only are they different up until the point of retirement, but they are different after your retirement age. So important to think about here, though, is at your target retirement age, should you be all in cash at that time? Or should you have equities? And if you think about it, if you're retiring at the age of 65, you may easily live another 20 years. And you don't obviously want to be all in cash for 20 years. That's not going to make you the most money. But there's a lot of debate right now on the to versus through on target date funds. And let me stop for a second. Anybody have a question burning that they want to ask before I keep going on? Okay.
No.
Okay, we'll keep going. Okay, so on the two funds, those are designed to end or basically be in cash at the target date with no exposure to equities, which it could be cash and bonds, but also to protect investors at the end when they're transitioning from what we call the accumulation stage, when you're accumulating, you're building your balance up, to the distribution phase, or you can call it decumulation, when you are required, you're going to start drawing that money out to live on. Now, the folks that are proponents of the two target date fund say that in the year 2008, everybody who was close to retirement should have been in cash so that they did not experience that market decline. The problem with a two fund is that it does force you at the time of retirement to make some decisions, and it forces you to take action because otherwise you're in cash and bonds, and you can't, your retirement portfolio shouldn't just be cash and bonds. So it does require you to think and take action, and a lot of folks who are service providers in the industry say, why force a person to make a decision and take action at that moment in time when we can simply continue to manage the funds or manage their investments through that retirement date? So the through funds, some of them call them target death funds instead of target date funds, because they're designed to continue to have the appropriate asset allocation for you through your decumulation years, through your retirement years. Those are what we call through funds. The majority of target date funds out there are actually through funds. Most funds, target date funds out there, all the large providers are through funds. They are not to funds. I want to stop here and ask, does anybody have any questions about to funds versus through funds?
Okay, on the second time, the through fund,
yes.
How do they estimate your target death day? Is it like 30 years, like you said, or 20 years?
Yeah, they all have a different target death date for you. I apologize, this is very morbid that we talk about this, but they do. They, they use actuarial tables, and they are projecting when you're going to die. So, for example, most of them use between 92 to 95 years of age. So they actually project you to live quite a long period of time. If you happen to pass away at the age of 75, the target date funds, most of the target date funds out there would not have best served you. If you actually do live to the age of 92 to 95, the target date funds would have been perfectly designed for you. So they do project it. There is one fund family out there. I know there's there's probably a couple that actually project you to live to the age of 100, but generally it's 92 to 95. Previously, 10 years ago, when we would look at calculations for distribution, like how you should be allocated in retirement years, was a target death date of the age of 85. Okay. But that keeps being expanded. Does that help, Jamie?
Yeah, thank you very much. Very good.
Okay, very good. Okay, and then here's another just a graph, for those who like pictures. I like pictures. So this chart is just showing a difference between the equity allocation in a to versus a through glide path. So the purple line is saying, let's get everybody to cash by the time they retire. And the green line is saying, well, no, let's get them more conservative, but keep generally a 30% to 40% allocation to equities in a portfolio through the retirement years. And you'll also hear words in the future called landing points. Landing points for every fund family is different. A landing point, let's say in the to example, a landing point is when do you reach the most conservative allocation in your for this particular series. So on a to fund, they're going to hit your landing point at your retirement age. On the through funds, the landing point, the most conservative allocation, will generally run between 5 years after you retire up until I've seen it up to 20 years after you retire. So again, the through funds, the landing point or the most conservative allocation varies between the fund families. I think on Vanguard and Fidelity, well, on Fidelity we've seen that. It gets pretty conservative within a 5 to 10 year window after you retire, and I believe Vanguard is the same. Within a 10 years after you retire, you're at the most conservative profile. Okay, so that was the glide path and the to versus through. I'm going to move on to fees unless anybody has questions. Okay, when you're calculating fees on anybody who knows me knows I'm a real fee hawk. I like to look at expenses. I think they impact your returns. I think they impact your nest egg in the end. So we're going to always keep an eye on those. Generally, the bulk of the fees are going to be the weighted average expense ratio of the underlying investments. So remember, a target date fund is simply a dynamic model portfolio. So in that model portfolio, you have all your underlying investments. We take the weighted expense ratios for all those investments, and what is your expense ratio for your mutual fund then? They used to historically put a wrap fee on top of the underlying expenses. That wrap fee was to charge to pay simply for the construction of the asset allocation. And operationally, they're actually making you more conservative over time. So they are placing trades in the sense that they're making your model portfolio more conservative, increasing your bonds, decreasing their stocks. So they used to charge for that. Most fund families have dropped and or waived that fee. So for those folks on the call that are using the Vanguard Target Date Funds, you've probably seen this screen several times. This lists all the underlying investments in all of the Target Date Funds. This lists the allocation of those underlying investments based upon the target date fund you're in. Now below that, the average weighted expense ratio for each of those funds are listed. So as you know with the Vanguard funds, it's all passive management, and so the underlying expenses are low, and the average weighted expense ratio runs between, I guess, 0.17% up to 0.2%. I've seen it up to 0.21% was the highest I've seen. So for those in the Vanguard funds, yeah, it's hard to beat those expenses. Let's look at Fidelity now. I apologize with Fidelity. They do not provide charts like the last one we saw. On the internet, you can draw the holdings list per fund. This list is a snapshot of the Fidelity Freedom 2020 fund, the percentage holdings in each of the underlying investments. The Fidelity Freedom funds tend to hold up to about 23 underlying investments. They all have different expense ratios, and so I use the Morningstar provides a fact sheet on this particular fund, and the average expense ratio for the Fidelity Target Date funds is about 0.71%. And as you also can tell, most of the underlying investments are actively managed, and hence why the higher expense ratio on these funds.
Question.
Yes.
So 0.71 is all we pay, or do we pay 0.71 plus a portion of the other management fee?
Very good question. So the question again was, is it 0.71 all in, or is there 0.71 plus any additional fees on top of that? It's 0.71 all in. So the only fees that would be on top of the 0.71, which nobody sees on any funds, would be the trading cost, because trading costs are not reported in the expense ratio. So the 0.71 is a fully weighted average expense ratio of all these underlying investments. Does that help, Jimmy?
Yes. So compare that to Vanguard. Is that better
yes.
or worse? I didn't catch the number on Vanguard.
Oh, Vanguard is about 0.2%. So
whoa.
yeah, it's about triple.
Okay. Thank you.
You're welcome. All right. Oh, I guess I should ask, that was it on the fees. Any other questions about fees? Because the wrappers, Fidelity does not add an additional charge, neither does Vanguard. So just the underlying expenses. On top of that, actually going back to, Jimmy, to your comment, you've got the 0.71%. It is, these funds are actively managed. The trading costs on these funds, which is not reported in the expense ratio, will be higher than the passively managed funds under Vanguard, because passively managed funds have lower turnover, hence lower transaction costs.
Even at 0.71, it doesn't look that bad at all, because if you buy individual fund, you can pay up to 2%.
Oh, absolutely.
I guess the bond fund is very low, right?
Yes.
Okay.
That's right, because when you get down to the short-term bond funds, you're probably looking at about a 0.4% on the expense ratio or lower, and some of the cash. There's a little bit of cash in here too. So that brings down some of the lower, because I believe you probably have the Diversified International Value Fund in here. That, that expense ratio, I believe, is above 1%. But they take the weighted average from all the underlying investments and brings it to 0.71%. Yeah. Okay, moving on past fees then. How can target date funds help you? Why do we even use it? Honestly, when I first started looking at target date funds, as an investment advisor, we have huge egos. So we never think any asset allocation out there is perfect or ideal. But why do I like target date funds? I particularly like them because they're dynamic. If I sit with you one-on-one today, and for some reason I don't see you again for 10 or 20 years, I know your portfolio is going to get more conservative over time automatically. So the question to you would be then, are you a conservative, moderate, or aggressive investor? Both the Fidelity and the Vanguard Target Date Fund series are both moderate, have a moderate risk profiles. If you have a conservative risk profile, they are probably too aggressive for you. which means not that you can't use them, but maybe you would want to put the bulk of your money in there and maybe put an additional 10 or 20% in your other cash investment options or bond investment options in your plan. So you can then tailor the target date fund to yourself. So I would recommend everybody find out what their risk profile is. How much are you comfortable with in equities? Is it 70%, 90%? Find out that answer first. Then look at your target date fund. Find out the equity portion in your target date fund and make sure it's lined up to what you need. Now also remember that they do become more conservative over time. So let's say your target date fund is 75% in equities, you're comfortable with 70% in equities, that there's not a big difference there. It will come down to 70% over time. So you can either wait for it or make your own personal adjustments on your in your investments today. If you need help with this, just contact me. We'll set up a one-on-one appointment and get that taken care of for you. Great. So just to review, we went over what a glide path is, went through the difference between a to and a through target date funds, the fees, and how they can help you reach your retirement goals. And I want to just open it up for any questions. Don't be shy. Somebody probably has the same question as you.